In its results for the quarter ended 30 September 2011, Harmony Gold reported a 45% increase in operating profit to 1.3 billion rand and a 217% increase in headline earnings per share to 92 cents. Harmony Gold said that its production was in line with forecast despite industrial action.
Harmony's got a market cap of 44 billion, price earnings of 21.5 and a dividend yield of 0.58%. Daniel, let's start with you. One of the keys I took away, and they trumpeted this all over the place, highest ever revenue. Great. In truth, we need to see it because we're also sitting on significantly highest ever Rand gold price, highest ever US dollar gold price, and Rand closer to 8 than 7. These guys are starting to get their revenue through, and certainly the flow to earnings. We're starting to see that leverage impact. We saw it from DRD last week. We're seeing it from Harmony this week.
Yeah, well, of course, the large increase in HEPS is largely due to a much higher gold price and a Rand that's actually weakened about 15% as well in the last couple of weeks. And that's really filtered through to the results. As you said, on DRD and on Harmony, Goldfields results are going to be released on the 10th of November as well, so I'm sure it'll filter through across the board. And a gold price that was as high as $1,920 an ounce, or $1,920 an ounce, now back to the low 1700s. Is it sustainable, these sort of levels? Is it consolidating here? Will it continue to remain at these lofted levels and perhaps actually pick up again and go back to its highs? And the earnings will continue to be strong like they have been. And again, it's a very volatile commodity, as we've all seen. And I don't know. I mean, it's as I said, very volatile. So if it can remain at these levels, I think they'll continue to have earnings at these sort of levels, and hopefully the gold price continues to move higher.
Ashraf, the CEO, clearly very bullish on the gold price, and he made that quite clear, but is he not talking his book when he makes that statement?
Oh, he's definitely talking his book.
He says that the fundamentals for gold are in place, but for me, gold has always been a speculative commodity based on sentiment. It is actually platinum that is a fundamental...
well, spot on there, Rafiel, but bearing in mind that, the gold price really moves on expectations of inflation and also uncertainty around the globe.
World.
Absolutely. Now, I've just spent the weekend cruising the internet and reading all the financial websites. And, there are certain pundits out there who say, carry on buying gold on the dips, because the view is that gold will go to $3,000 to $5,000 an ounce. Now, they never give a date as to when, but the reality is that when we sat here at the beginning of the year and anyone said $1,800 an ounce before the end of the year, everyone would have turned and gawked and said, you got to be crazy. But the reality is we went well past 1,800, peaking at 1,920. And, again, they don't only have operations in South Africa. They are building operations. Papua New Guinea is the one we know about. And in fact, I was surprised, no comment in terms of their rights, because an issue was raised a month ago regarding their rights, especially with it moving from government to community. Nothing was raised in this results commentary, but an excellent set of results, and one can only hope that with the Rand gold price still remaining fairly high, they're going to show good earnings in the final quarter of this calendar year.
In essence, Ashraf, will stay with you. I mean, they need to, cash costs are now up at 11.56 an ounce. It's not much from previous quarter. It's up significantly from a year ago when it was 9.74. And that's the hit they're getting. And that is Eskom, which was 133 million, 10% of operating profits. It's labor, it's depth, etc. Papua New Guinea will be a different story. They need this gold price to go in their favour, because if it starts to pull back, they get the crimp.
Well, that and Papua New Guinea has to come online before that gold price pulls back. Otherwise, they're going to sit with far tighter margins. But again, for any speculator who wants to trade gold, Harmony have just announced that they're the stock to trade. Because if you look at this volatility in earnings, and it's just been the gold price, this is classic gearing to the gold price, something I learnt in finance 101. It's, price goes up, costs remain the same, and profits straight to the bottom. My only concern remains that, the growing electricity cost will hamper them in the future. So they have to find a way to deal with it going forward. But my view is that in 5 years' time, especially once Papua New Guinea comes online, 50%, at least 50% of the earnings will be coming from offshore.
Daniel, let's expand on the topic of Papua New Guinea. Now, there's talks that the government wants to move the mineral rights ownership from themselves over to local communities. What is the likely impact of such a move on Harmony? And secondly, it's so reminiscent of the nationalization debates happening here in South Africa that I wonder whether they will be able to get around it in any way. What's your take?
Oh, look, I think first of all, the question is if they do actually happen to get Papua New Guinea going. It is still in the exploration phase. So I think there's still a lot of work and a lot of issues to be cleared before that does go ahead. So I still think it's not a certainty. And again, that'll take a couple of years to unfold. And with that being said, 90% of the output coming from Harmony Gold is South Africa. And as you go to the nationalisation query, if they've tried to nationalise mines for years. If it doesn't happen, and it seems like it won't because they've tried so many times and failed, but if it were to happen, and 90% of the output is from Harmony, is from South Africa, I think it puts a big dampener on the share price or on the share and a company as a whole, as opposed to like a Goldfields or an Anglo Gold. They've got a lot more output happening elsewhere. And not as much as 90% only coming from South Africa. So I think there's a lot of questions and queries as to if it should go through.
Ashraf,
I want to
take
a point there because it's an opportunity in the longer term, because when governments nationalize, they can't just take the assets and say that's it. They have to pay compensation. And if I were Harmony, I'd say happy for you to take these assets because your extraction costs are only going to increase. So your cost, Simon spoke about an 11.56 an ounce price. Quite comfortably, if your labor costs are pushing aggressively as well as your extraction costs, you could find yourself at 1,400 an ounce, and then you're really marginal and making losses at times. If the gold price reverts to norm, but that really depends on your view. My view is the gold price edges higher, so I don't see them making losses. But yeah, if I were Harmony, I'd say take the local assets. I'm going offshore.
Because no one wants the South African assets. They're deep, they're nasty, they're horrible, and they're expensive.
If you were a gold miner and you just decided, okay, I've got a mine or a dump in South Africa that I'm operating on, but I can take my cash anywhere. Right now, South Africa would not be the place where you'd want to be. You'd be looking at far cheaper extraction opportunities than
But
right
then
here.
isn't there if nationalisation doesn't happen, and it's an if whether it will, but let's say we don't get nationalisation, the idea, when we've thought about it, particularly Goldfields and Anglo Gold Ashanti, because much bigger international exposure, to split Harmony into Harmony SA, Harmony Papua New Guinea, because shareholders obviously put a premium on the non-SA assets.
Sure. And that could very well come. Harmony International would be the play as a number. Newmont Gold is one of the best gold players offshore. Anyone sitting with offshore cash and taking a view on the dollar gold price, that's the one they normally play for.
Are you going to say it's a hot stock or not then, Ashraf? Harmony Gold?
To me, it's a hot stock, and that's really based on my Rand gold price view.
Clearly quite bullish on that too. Daniel, hot stock or not? How do you feel?
For me, looking back 10 years ago, Harmony was trading at 180 Rand a share. 10 years later, with the gold price currently where it is relative to where it was 10 years ago, it's clearly underperformed everything massively. And I don't see why I would be buying Harmony at these levels. It's struggled to get through 100 Rand, and it's finally broken through. And for me, again, only if Papua New Guinea were to come through would I be interested. And I'm not going to base my decision on that. I think there's too much risk. So for me, not hot. I would rather go with Goldfields or Anglo Gold.
Not hot for Daniel, hot for Ashraf. Simon Brown is all that glitters, Harmony Gold.
These are sterling results. This is what you want to see from your gold miners. DRD were good, but these are absolutely great results. I think it's going to be, it comes down to what Ashraf says. What is your view on the gold price in dollars, and what's your view on the Rand? I think the Rand is going to be stronger, and then the question is, so is gold going to offset it? And I'm not convinced by that. Ashraf mentions inflation as a next threat down the line that will help to drive gold. We need to start seeing that coming through. So I'm going to throw it out there and say, if you really think gold is going to the moon, Harmony is a good mine to be going buying, and if not, stay away from it. Personally, I stay away from gold mines.
Not hot for Simon Brown. Let's move on to Capitec Bank now. They intend issuing up to 4.6 million new ordinary shares of 1 cent each. The placing will be used to facilitate an increased footprint in South Africa, boost its client base, and grow the loan book while managing capital requirements.
Capitec market cap 18 billion, price earnings 20.1, dividend yield 1.74. Daniel, this is a book build that did a rights issue a year ago. In one sense, I suppose, when you've got a share that's trading, what's it, 180, north of 180 today, you've got a share at that sort of price, and no one's going to call Capitec cheap. You use your paper to buy assets or to raise cash, and that's what they're doing. The market wasn't so sure, pushing them down some 4% though.
Yeah, correct. Look, they, as you said, Capitec trading around 185, between 185 and 190, was down 4% today. It's quite expensive. It's trading at a PE well above 20 relative to the other banks trading around 10 or 12. So management was actually very, very clever to actually do a book build at these sort of prices. They're getting a lot more for it. So very clever, as opposed to some companies who would do a book build and try and raise cash, when they're in trouble and they've got huge debts and they can't pay staff, for example, and they really get themselves into a mess. Here they're doing it for the complete other reason, to try and grow. It shows an aggressive nature in their approach to trying to get more business and to grow. It looks good. I think it's a good thing that they're doing it at these prices.
Ashraf, they've always had the reputation of being innovators. But for me, the route of offering insurance products is actually just following the herd, because the big four banks are in that market already, offering these insurance products to the lower end of the market. And then on the other hand, they're talking about a long-term vision of financing up to 500,000 Rand unsecured. Now, unless they've got a credit assessment model that is second to none, how are they going to manage the risk of unsecured lendings at a R500,000 Rand level? And then your comment on the insurance products.
Okay, well, the credit assessment model, I think, is proprietary, and it's been built up with years of experience. Given that this team comes from Boland Bank, and that's really what they did originally. So when Capitec set out, and we've got to go back to 1996, 97, when Michiel Leroux actually put the concept together. It was really based on his experience at Boland Bank. He brought that in. So over this past 15 years, they've built up a strong database of experience, and given their conservative nature, my view is that 500,000 unsecured lending, I'm sure that they would even be comfortable with 1 million, but they've set the bar lower to manage that risk.
And it is just the credit, because the CEO said it's about how you score it.
Correct. And they found a methodology that works for them, and we've seen it in their results. Return on equity of 29% to August highlights the fact that they are managing their assets effectively. And you speak about a rating well above that of the banks. That's at a premium of almost 70% to the other banks. But the other banks couldn't get ROEs beyond 15% this year. I think First Rand managed 18% to June. So definitely a business that's showing a lot of growth. But before I continue, I have to say that Regiments Capital are the empowerment shareholder in Capitec. So my views may sound a bit tainted from everyone.
Only a little tainted, Ashraf.
The insurance angle, in one sense, I look at it, we said everyone's selling insurance. The flip side is they've got their clients, 3.2 million. If they can do to insurance products, and I'm thinking low-end products perhaps, to what they did to banking products, they could undercut everyone and again shake up the industry. Discovery's done it for the rich folks, they can do it for the lower end.
And if you look at the big banks, their footprint, a lot of it's invested into bricks and mortar. These guys have fairly low cost when it comes to bricks and mortar, and that's the reason why they don't charge their clients such high banking fees, because banking fees are really there to recover costs and make some small margin. It's not there for any other reason.
Daniel, there was an issuance of 2 bonds amounting to 1.3 billion Rand under the domestic medium-term program in May 2011. What would make holding the debt of Capitec as opposed to shares more attractive?
You need to understand that when the people do decide to take up more shares on an issue like this, they're getting involved because they do obviously feel that there are large growth prospects still at these elevated prices as well. So if it is being issued at a slight discount to the current trading price, I think there would be a lot of interest to take up this offering. And I think I'm quite interested to see what the book build, if it will be oversubscribed or not. I'm sure it'll probably get oversubscribed quite quickly. I think a lot of people want to get their hands on it, and very confident in the business still going forward. It's actually not a huge offering. They're actually only issuing 4.6 million shares, so it's about 5% of 5% extra than what they currently have. So it's not a huge amount, and shareholders won't be too diluted. So I think going forward, it's good for shareholders, and I think shareholders who currently hold stock already won't be diluted too much, so it's not too much of an issue.
So are you one of the people who's going to rush out and get your hands on this new issue then?
Is this a hot or not question?
Yes, hot or not. You read between the lines.
I'm mixed. I'm hot for one reason and not hot for another reason. I'm hot because I like the way that they are doing this. I like the way that they're growing. I think there's huge untapped potential that they can still get involved in. A huge base that they haven't even gotten into at all. And I think there's still a lot of growth, and if they continue with that, then they'll be able to carry on having HEPS or headline earnings per share of 50% plus year on year going forward for a few years to come still, hopefully for a sustained period of time. And the reason why I'm not hot is because with interest rates at these current levels so low, or not so low, where they currently are, bad debts aren't really an issue or not a problem. But as interest rates start to pick up and start to increase slowly over the next couple of years, will the bad debts start to increase? And for me, that becomes a little bit of a problem. So at these levels, I'm really also on the fence. In a way, I'm hot. I like the structure. I like the management. So I'm hot in a way, but I'm not boiling.
Indecision is the name of the game for Daniel Krause. Like sitting on the fence. Yes, we feel I'm hot. No, actually, I'm not so hot. Ashraf, hot or not for you?
Well, I like this business when one looks at the fundamentals. And to take one of Daniel's points, he said with higher interest rates, there's risk. But I think employment is the bigger issue for them. We've seen increased unemployment at the LSMs that they focused on, but we haven't seen a significant increase in bad debts on their books. So my view is that risk doesn't really warrant much concern. And from where I stand, it's a good longer term investment.